Good afternoon, everybody, and welcome to our second quarter portfolio commentary. Obviously, it's been an incredibly eventful 3 months, and we're here to give you a bit of a recap of what's been going on in the markets and how the portfolio is done. This quarter's quote is from Warren Buffett, and I think the quote is very telling of what we've just lived through. When he says, "The stock market is a device for transferring money from the patient to the impatient." And Matt will walk us through a section right at the beginning that will explain just that. As always, a quick disclaimer: anything you hear today are Matt and my opinions. They do not represent the opinions of our firm, HollisWealth. Okay, Matt, you want to take us into why that Warren Buffett quote is so relevant?
Well, you've probably heard Lorenzo and I speak about the follies of market timing. Let's take a look at how it did during the beginning of this year. So we've always said it's been difficult, if not impossible, to consistently trade in and out of the market successfully. So instead, we've always relied on a diversified portfolio of stocks, bonds, private investments to create that smoother return pattern during volatile periods. However, if you were tempted to step to the sidelines, go into cash in March during this very volatile year, you can see the results below. So if you stayed invested, you'd be down about 1.6%. That's the black line. If you were the individual who went to cash for just 5 days and missed the 5 best days year to date, your portfolio would be down 22.5%. If you missed just the 10 best days, you'd be down a whopping 36.6%. So you can see the follies of trying to time the market. And that's an important lesson to learn as we move further into this recovery and we get further bad news ahead, whether it be US elections, US tensions with China, or growing infection rates. So what really is driving the market higher? Well, it really seems that investors' fears have been averted. We're looking past the infection rates now and now focusing on the record levels of stimulus and low interest rates moving forward. And that's what's reflected in the two charts below. You can see the infection rate slowly decreasing from, March through June, and you can see the stock market rallying on that. And that coincides with the huge amount of stimulus the Federal Reserve put in place. And you can see their balance sheet expanding and the market following that. So that creates a very supportive environment for the stock market, and that's why we've seen the recovery that we have. Now, not everything has recovered at that same pace. What we're showing here is the Toronto Stock Exchange peaking out on February the 19th and then declining 37%. And then subsequently rebounding 38%. So you can see high quality defensive names generally outperformed on the way down, while on the way up, they've lagged. What's really driven performance is gold producers and now Canada's largest company, Shopify, and they accounted for about 60% of that gain from the bottom. And that's not unlike what's happening in the United States, where Facebook, Amazon, Netflix, Google, Microsoft have really driven the performance of the S&P 500, and they also represent about 1/5 of the market right now. So again, not everything has recovered. It's really the large tech names, and in Canada, some of the gold producers.
So let's translate that into how have we done performance-wise. Obviously, it's a big question everybody wants to know. This data is now a month old. We're recording this video on the 31st of July. So as of the end of the second quarter, Toronto stock market is down 9%, S&P 500 down about 4%. Emerging markets developed markets and emerging markets internationally down about 10 to 12%. In that period of time, income model down 2% and the growth model down 0.2%. As of today, actually both models are in the black for the year, which is very exciting. Again, our philosophy, the key thing to understand is our goal of always trying to minimize downside loss. Trying to, as much as possible, deliver positive returns on as regular a basis as possible every year. It's much easier to recover from a 5% loss than it is, from a 20% loss. So really quickly here, we're just going to cover what changes we made to the portfolio this quarter. We've already covered these a few times in some of the webinars and other communications, but for those of you who perhaps missed some of those, Effectively, one of the big changes we made was on March 12th, kind of right at the heart of the crisis. We saw that there was a lot of concern that companies might default on their debt, which is a pretty common thing you see in a market downturn. And so what we did is we got rid of our high yield positions, on March the 12th, mainly held through PIMCO monthly income. As you can see, it was a well-timed decision because that red line, the high yield index, plummeted quite significantly in, the following weeks after that. And then once things started to stabilize in early mid-May, we decided to rebuild our fixed income portfolio. And so what we did is we did a kind of a complete rethink of, how we're putting together those pieces. Half of it right now is in corporate bonds, both actively managed through two positions, Manulife Strategic Income and Manulife's Unconstrained Fixed Income Fund. We've got our government bonds now sitting about 35% of the fixed income weighting. We significantly trimmed those. Those were essentially, that portfolio insurance that we put in place in September of last year when we were concerned that, the markets, might get more volatile, might downturn. Those bonds do very well, when things get ugly in the market, but generally don't do very well at any other time. And so we've pulled back those kind of mid to long dated government bonds and trimmed it down to only 35% weight in the portfolio. And then the short-term bonds, the ultra short-term bonds, which is effectively like cash, is about a 15% weight. Again, we had more, but since we have a larger cash weight in the portfolio now, we've essentially trimmed that corporate bond, ultra short-term corporate bond position down to only 15% weight. The last thing we did in terms of what we built in this portfolio this past quarter was we purchased a structured note in the model. Now, not to be confused with the fact that many of you who are in our income models also purchased the structured notes that we customized for clients in was it June? No, was it May? May and June, of this past year. We had an opportunity to buy a structured note that had been created by CIBC right in the heart of the volatility that we saw in April, and it had a feature set that is the most attractive that I've seen in my 17 years in this business. Effectively, we had a coupon note based on Canadian banks, which effectively pays 10% every 6 months, as long as those Canadian banks are trading between 80 cents on the dollar, and $1 on the dollar. At the one point, you will get taken out. So effectively, on any 6-month observation where those notes, the bank's trading, are worth more than what you purchased them for, you'll get that last 10% payment, and you'll be done. Realistically, we expect this note to probably survive in the portfolio 6 to 12 months before being called back by the bank. But in that period of time, we will have seen, potentially a 10 or a 20% return, in that period of time, and which we thought was a very attractive risk to return proposition.
Yeah, so as Lorenzo mentioned, we're fairly active during the quarter, and given our success year to date, we feel pretty optimistic that the portfolio is well positioned to ride out this pandemic and any kind of volatility that may ensue. So that concludes our Q2 commentary, and we'll see you next time.
See you next week.